Hey guys, what's up? How's it going? Welcome to today's video. And in today's video, I'm going to be giving you guys an entire September stock portfolio update in this video. And what we're going to do is I'm going to break down all three of my portfolios and give you guys an update on how all my portfolios are doing. And I'll give you guys an update on dividends and whatnot and show you guys the stocks I've been buying and show you guys how my portfolios have been doing for the month of September. So this is going to be a pretty long video, so bear with me guys because we're going to be diving into each stock individually. I'll show you guys my total returns, I'll show you guys how much stocks I hold, and I'll give you guys an overall plan of like what I'm kind of trying to do for the future. And the three portfolios that we have in today's video is going to be my first portfolio, which is going to be with Wealthsimple Invest, and this is a robo-advisor. This is like a high growth, kind of mixed, diversified portfolio. And then my second portfolio is going to be with Wealthsimple Trade. This is going to be my dividend portfolio. This is kind of more of a Canadian stock based portfolio with a little bit of US dividend stocks mixed in. And then I have my third portfolio, which I will eventually stick into my dividend portfolio, which is my Canadian REITs. So we're going to go over through all those portfolios inside this video, guys. So if you guys enjoy this video and you guys want more content like this, be sure to subscribe to the channel. And if you guys do enjoy this video, please do me a big favor and give it a big thumbs up. So we're going to jump inside the Wealthsimple Invest portfolio first. So let's hop on over to Wealthsimple Invest and let's see how my growth portfolio has been doing on Wealthsimple. Alright guys, so here's my Wealthsimple Invest growth portfolio. This is the high growth, high risk portfolio in Wealthsimple. I created this portfolio a little back in March of 2019. This is way back when I first started investing. So the portfolio is about a year and a half old, and I didn't really know anything about investing when I first started this portfolio. So I just put a bunch of money in, and I just kind of been building it up over time. And here we are today. So the portfolio is up we have $50,000. $294 Canadian, and it is currently up $2,632 as of date. And when I first started investing, I didn't know too much about investing, so this Wealthsimple trade portfolio on the robo-advisor was really good for me. And this is something I recommend that all beginners do if you're just getting started with investing and you don't really know too much about buying your own stocks or even just buying your own ETFs. Find a robo-advisor. If you're Canadian and you're looking for a good one, I would recommend Wealthsimple Invest. It's the one I've used and had pretty good result with it, as you guys can see. I'll put a link in the description of the video if you guys want to use my affiliate link. You'll get $50 for free if you put $500 into a Wealthsimple Invest account, and it's totally free to do so. You guys can use that link if you want. But otherwise, there's not too much going on inside this portfolio. It's based out of a couple different ETFs, and there has been some changes over the past couple days. So we're going to dive into the portfolio, and let's take a quick peek at how the actual ETFs and the individual ETFs and returns are doing. So here is the total return rate here, and I'm going to put this to a simple percentage just so we can see it. And overall, simple percentage, this return is giving us a 3.3% return. And keep in mind, we did have this portfolio pre-market crash, so a lot of the stocks we had a lot of money in there before the crash happened, so they're still kind of recovering, but we're still kind of sitting a little bit above. And you'll see that most of these ETFs, like year to date, they're kind of sitting about to be around that 0%. But because we did invest throughout the market crash, we did kind of get a little bit of a boost there. So it's nice to see that. But here's each individual ETFs that we have inside the portfolio here. And the first one we're going to start off with is one of my favorite ones. And this is probably the best performing ETF so far. And this is VTI. And this is based out of US based stocks. And this is inside a TFSA, which is a tax-free savings account, which is an account you definitely want to get set up. Now, traditionally with a tax-free savings account, most people think of a tax-free savings account as a savings account that you can put money in from a bank or something like that. You know, and maybe you get like I guess nowadays you would get like a 0.2 or 0.5%, maybe even a 1% if you're lucky. But I would highly recommend that anybody who's using a tax-free savings account, open up a robo-advisor, stick some stocks in there, and you'll get such a bigger gain, because with stocks, you might get like maybe like 5 to 10% on average return, assuming you're investing in good ETFs. If you invest into a robo-advisor like Wealthsimple, you'll most likely get that. So 5 to 10% tax-free is so much more than just like 1% you might get at a bank. So if you're brand new to investing, open up an account with a robo-advisor, open up a tax-free savings account, and start maxing out your contributions, because that's the best thing you can do to start earning money tax-free. Alright, so back inside the portfolio here, let's go over these holdings really quickly, guys. So we have 22.8% of the portfolio is in VTI, which is a Vanguard stock market ETF, which once again is heavily based on the US stocks. It's got a mix of growth stocks, some dividend stocks, but it's a little bit of everything. Mostly like high yielding, high growth stocks inside the US economy that have just done well over the past little while. We have $11,000, $476 in total, which equal about 50 shares, and that's a total gain of date of about 11.7%. So VTI has been pretty good for us, and because we've been investing it throughout the market crash, we're sitting at a pretty good return right now. Especially when US stocks like just really rebounded really good, we got a nice little boost there. The next one we have is XEF, and this is international equities. This is 21.8% of the portfolio. We have $10,000 in there. Actually, I should say we have about $11,000, 10,951, 365 shares, giving us a total return of 0.3%. So international equities still, once again, lagging behind US stocks, and everything else for the most part, as you'll see in this video, is lagging behind US stocks, sitting at 0.3% return. So we're kind of still investing into them. They will go up eventually. It's just a question of when. Will it be later on this year? Probably not. Probably sometime next year or the year after, we should see like a nice big jump, and all that investing we've done throughout this year during the market crash, like when stocks have been down, we'll get a nice good return there. So we're still gonna, like, I still like the idea that Wealthsimple invests basis most of the portfolio with US stocks, with a little bit of international equities, and just a tiny bit of Canadian stocks, as you'll see as we move on further with the video. But the next one we have is EEMV. This is another international equities ETF from iShares. This is based out of Asia. So a lot of like Chinese, Japanese, all those kind of stocks, all those little, those Asian countries and stuff like that. We have $8,425 in EEMV, and of course, because of things that have been going on, this one's probably been hit the most with a negative 3%. But once again, eventually at some point in time, this will rebound. So we're putting money in now because remember, like one of the most important things you can do during a market crash is keep investing money. In fact, a lot of beginner investors will look at a market crash and get really worried, right? Like this year on paper looks pretty bad. If you look at most ETFs, most stocks, we're sitting at a negative, we're sitting at a zero. But if you guys invest throughout the market crash, not only through this year, if you put money in from the start of the year, especially in March, to where we are today, you might even finish the year at a positive. And then at next year, when stocks really get a huge boost, you'll get like even almost like a double whammy, where you'll get like that increase from the stocks going up, but also because you invested during the market crash, it'll go up even more. So now is the perfect time to invest. I know a lot of people like are kind of freaked out and stuff like that, but I swear to you guys, if you invest now during the market crash, as long as you invest in good quality stocks, like pick some good ETFs, pick some good quality stocks, and you'll do fine going in the future. This is the time to invest, and you'll get such a good result. And as you can see, even with our portfolios, we're doing pretty good, even though the year has, for most stocks, are sitting in a negative or 0% right now. So the next ETF we're going to look at is ACWV. Once again, this is a globalized ETF. It's 11.3% of the portfolio. We have $5,697 in here, 46 shares, and once again, just like EEMV, it is down about 0%, sitting in that range. This is kind of has a little bit of everything: U.S. stocks, European stocks, bit of a mix. Once again, this is just Wealthsimple's attempt to diversify. And then at the bottom here, we have XIC. Which is our Canadian equities. Now, we only have 10% of the portfolio in Canadian stocks and with this portfolio, but you'll notice that some of my other portfolios kind of have a little bit more Canadian stocks, but generally speaking, we still have way more money in US stocks, right? Like if we go up here, you can see we have $11,000 in VTI. We have a little bit from these ETFs here, and then we have VUS at the bottom here, which I'll get to in a second. So we still have most of our holding in US stocks. So that's why I buy a lot of Canadian dividend stocks, and I'll stick them inside my tax-free savings account. But I also do that because the earnings from Canadian stocks inside of a TFSA is tax-free. So I kind of do that too. But the whole point of this portfolio is like diversification here. And we do hold a little bit of Canadian stocks. Now, Canadian stocks had, just like foreign stocks, they're kind of lagging behind. They kind of crawled up a little bit, but they kind of went back down. And now we're kind of just sitting at that neutral zone, right? But we have $5,678 in Canadian stocks, 220 shares, with a 0% overall return. So that should go up, whether it's towards the end of this year or over the next couple of years, which is why we keep investing into them. But remember, it's just a small percentage of the portfolio. I still believe that US stocks overall are probably the main thing you want to invest into. And at the bottom here, Wealthsimple has a US equities Canadian hedged fund, VUS. This is once again almost like a hedged version of VTI to some degree. We have about $3,000 in here, 46 shares, and once again, just like VTI, it is sitting at 11% gain. So pretty big gains from US stocks, and that's kind of to be expected since US stocks have performed pretty much every other stock market just sector in any part of the world, really. So US stocks are definitely always smart to base your portfolio off of US stocks. Next up we have is our bonds here, and we have government bonds, and then we also have this interesting gold ETF. This was a new trade, a new mix that Wealthsimple introduced a couple weeks ago. They traded I think it was Q-tip that we held before. It was like a Canadian hedged US bond. They got rid of that and they stuck in this gold. Now the funny thing about gold is I'm not too familiar with gold investing, and it's not a dividend based fund. Like, you don't get like regular monthly earnings. So it's kind of interesting that they put this in here, and you can see they changed this. It used to just say fixed income, but now it says fixed income in gold. So I'm going to have to do some research about gold. I don't know too much about gold. I mean, it's only like $1,000 of the portfolio, so kind of interesting to see. But this is GLDM, so you guys can take a peek at that. Kind of interesting. They bought $1,000 worth, 50 shares, and so far over the past couple weeks it went up 1%. And I think the reason why is because gold has had a good history of rising over time, so I think that's why they made that change. But once again, if any of you guys know about gold, feel free to let me know in the comments section. I'm not too familiar, but I found that very interesting that they made that trade. And then the last ETF we have is the ZFL. This is Bank of Montreal long-term federal bond ETF, currently sitting at 10% performance, which is pretty good, but eventually over time this is going to balance out as stocks kind of start to rise going into the future. So bonds obviously aren't going to sit at this height. We'll have to wait and see in the future, but they'll probably start to go down, and they have actually gone down a little bit, but they're still sitting at 10%, which is pretty decent. And we do get fixed income inside this portfolio. So overall portfolio is 90% equities, 10% bonds. Now the next thing we're going to do is take a peek at the dividend income of this portfolio, because it's also important to talk about dividends, and because it is September, the third quarter, we do have lots of dividends coming inside this portfolio. So those of you who are wondering about yield inside this portfolio is basically based on the growth stocks. So most of the return comes from the stock assets and the stock actual value growing over time. So like, let's say you buy a stock and it costs $20 or so, and then like over a year or two, maybe it rises to like 30 bucks or something like that. That's that stock appreciation. That's what most of this portfolio is based out of, but it does have a little bit of dividend yield. I think it has about a 2.5 dividend yield. That might have changed over the years, but it's something around that 2 to 3% range. So it's kind of on the lower side, but we still get some good dividend yields from this portfolio. So let's go over the dividends and let's see how our Wealthsimple Invest dividends have been going for September. All right, so one thing I really like about Wealthsimple Invest is they have a nice clean user interface, and they allow us to kind of really sort everything really simply and very easily. So we're going to go inside here and we're going to go to dividends and interest, so we can take a peek at just our dividends. And we're going to look at September here, and here's our dividends. So I think all of our dividends for September came in over the past couple days. So September 2nd, we had a dividend from ZFL, which is $7.65. And keep in mind, Wealthsimple does reinvest this money. So any dividends we make are going back inside the portfolio, which is good, so we can buy more stocks, especially since they're priced really, really low right now. On September 30th, we got a dividend from XIC of $46, which is pretty sweet. And then on October 2nd, we got some more dividends, once again from ZFL, and then VTI. This VTI dividend actually was supposed to come on September 30th, but for some reason it shows up in the second here. Maybe it was a late reporting or something, but we got $45 from VTI, so that's a pretty sweet dividend. And once again, Wealthsimple will take that money and reinvest it so we can buy more shares at a regular rate. And one last thing I want to show you guys before we finish up this portfolio, before we finish up this portfolio, then we jump inside the Canadian dividend-based portfolio. I just want to show you guys how much money I've been putting inside this portfolio over the past little while. So we click on here, we can see the deposits over the past couple months. So once again, I've been focusing on my dividend funds, but I've still been kind of putting some money in here and there. So September we put $84, August $100, July $35, and then June and May obviously we put a lot more. Over the next little while, I'm probably going to put a little bit more money inside this portfolio, but it just depends, because I'm going to have to pay attention to my TFSA contribution room because I am reaching my limit. So that's something I'm definitely going to have to pay attention to, but I definitely will be putting more money inside this portfolio. Alright guys, that's it for the Wealthsimple Invest account. Let's jump over to my Canadian dividend-based portfolio on Wealthsimple Trade, and let's see how my dividend stocks are doing. Alright guys, so this is the Canadian-based dividend portfolio. Once again, we'll go over each holding individually, and I'll show you guys the different, how many shares we have. I'll show you guys the total return, and I'll do a dividend. In this portfolio, I do track on a monthly basis how much we make from dividends, because it is a dividend portfolio. And once again, if you guys want to follow alongside with me, I did build this portfolio completely from scratch on this channel. I do updates on every other day kind of thing. I'll put a playlist in the description of this video. You guys can watch the playlist and you can see how I built this portfolio completely from scratch. If you guys feel like been watching those videos, you can. Otherwise, just watch like the last update I've done and you'll kind of get a better idea if you don't feel like watching the older updates kind of thing. But here's the portfolio right now over the past day. we are up 0.15%, which is $8.74. So the Canadian markets are up a little bit. Over the past week, we are up about $14, which is 0.26%. So we've seen a little bit of a rise over the past week in our stocks. And then over the past month, we're still kind of down overall. We did get a big drop kind of towards I'd say like the middle of September, and we're kind of still recovering that. So we're still down 1.86% from the past month, which was September. And then over the past 3 months, we're almost breaking zero. So we got a lot of gains, and we kind of got a lot of losses. And now we're kind of just, once again, kind of in that neutral zone overall. And all time, the portfolio is down about negative 1.44%. So almost breaking even, give or take. So before we go any further, let's take a quick peek at the dividends and let's see how much money we've made in this portfolio. So here's the quick little spreadsheet, guys. I'll go over this really quickly because we have a lot to cover, like I mentioned. But this is the dividend tracker. This is how we track all the dividends of what the portfolio has made. So total dividends in total from this portfolio is $77 over the course of, I guess, going into the 9th month now. And as you guys can see here, in the very first few months, we didn't make a lot of money with this portfolio. But over time, as we kept investing money, as we kept putting money in on almost a daily basis, I would say, it's been slowly climbing, like, 44 cents to $4.35 to $7.79 a month to $13 a month, and then up September, $28 a month. We had a really big month, but obviously, September being the third quarter, a lot of stocks pay out dividends. But regardless of that, $20 to get for 1 month for the portfolio is huge. That's almost double from last month. So that's pretty sweet. We're pretty happy about that. And once again, we're just regularly putting money inside this portfolio and growing it over time. So let's jump back into Wealthsimple Trade and let's take a peek at each of the individual holdings inside this portfolio. Alright guys, so here in this part of the video, we're going to go into the lightning round, which is where we're going to kind of like fly through these stocks and I'll show you guys the different holdings and whatnot. If you guys want to kind of see a clearer picture, just pause the video whenever I get to a particular stock. I'll try to have the screen there so you guys can see it, or if there's anything I missed or anything you guys are wondering about, and if you guys have any questions, just leave a comment in the comment section of this video and I'll try to get back to you as quick as I can. So the first stock we're going to talk about are the Canadian banks, and Canadian banks are really good dividend stocks. They're really, really good valued, and they have a good history of growing, increasing dividends, and I think they're probably the best stocks to buy in Canada, in all honesty. So I've kind of been buying them inside this portfolio here and there. Keep in mind, this portfolio is predominantly based out of ETFs and predominantly VDY, which is a finance/bank-based ETF. But I do like to buy a little bit of holdings here and there, just to kind of to add a little bit more extra and to just kind of buy stocks because I like to do that. But ultimately, I want to make sure I'm not doing any stupid things. So I want to keep the portfolio mostly weighted in ETFs just in case, if I make some bad buys or something like that. But this is Bank of Nova Scotia. This is the first bank stock over the past day. Bank of Nova Scotia is up 1.26%, so it rose quite a bit. And if we go, I guess if we go down here, we can see the different shares and whatnot. So we have 3 shares in Bank of Nova Scotia, valued at 1.68% value, 2.89% of the portfolio, and total return is $1.20, which is 0.72% overall. So this one is, we haven't bought too many shares of this. I've kind of been buying the other banks, but I might be buying some more shares of Bank of Nova Scotia in the future. But keep in mind, all these bank stocks are actually in my VDY ETFs. So I've just been buying a few individual ones that I want to kind of just put a little bit more money in, specifically TD. But I'm still buying some of the other ones here and there just to have fun and pick some stocks because, you can't go wrong with the Canadian banks. Next up we have is CIBC. This is up 0.48% in the past day. We have 2 shares of CIBC, total value of $199, 3% of the portfolio, and total return is 6.65%. So pretty good return from CIBC. It's kind of been going up and down along with everything else, but pretty much every time I've done an update video, CIBC has always been performing well, and we did buy these in the past couple months. So nice little return overall. Next one we have is Enbridge, which is a classic Canadian power utilities company. I haven't bought too much of Enbridge because we do have it in VDY, and Enbridge is kind of a weird company where they have really high payout ratios, they have a lot of debt, but they still continue to do well. Like, they're kind of one of those weird, it's a perfect example of that weird stock that just doesn't follow the rules, but still does okay. Going into the future, who really knows what's going to happen with Enbridge? I think they're still going to be fine, but I don't want to put too much in Enbridge because they're kind of like that riskier play, and they don't follow the rules when it comes to traditional dividend stocks, right? You want, companies with a lot of money, low payout ratios, and Enbridge is just not one of those companies, but they still continue to do okay, and they're a big player when it comes to Canadian dividend stocks. So we have a couple shares, but we're not going too crazy just because of that. So we have 3 shares Total value $115 and about -6% overall. So a bit of a loss from Enbridge, but remember, we haven't been buying it on a regular basis. So that's pretty much why. Next up we have is Fortis. And Fortis is kind of like the opposite of Enbridge. Fortis is a stock that has very good payout ratio. Not like perfect payout ratios, but a much better payout ratio, much better finances, and they're more of a slow kind of growing over time. They have a lower dividend yield and a lower dividend, but they're kind of like set up to grow it more over time. So that's why I kind of like Fortis a little bit better. And they're much more stable in terms of returns and whatnot. They're not kind of going all up and over the place like Enbridge is. So we have 3 shares of Fortis stock. I do need to buy a few more, as I do think it is a good stock, and I probably will be buying more over time. But we have currently about $164 in total value, and total return is about 2%, and they have a nice little yield of 3.48%, but it's growing on a regular basis. So I think this is like a good opportunity stock that's probably going to grow in the future. So that's why I've been buying Fortis. Next up we have is Manulife, which is an amazing Canadian company. They've kind of once again they had a really good start when the pandemic happened, and then they kind of went down, and now you can see even in the past day they're up 2.11%. So they've been kind of rising over the past little while. If we go over the past month, we can see that they had a nice little dip with everything else, but it looks like they're maybe kind of going up here. We have 14 shares of Manulife. It's a nice cheap stock, so it's easy to buy, which is $264 overall. Return of about -9.7%. We still have a little bit of recovery, but this is a good stock to buy right now because it's still priced really, really low. It's got a really high yield, and they have really good finances, and they've had good earnings this year, even though they've taken a big hit. So Manulife is definitely, I'd say, one of those stocks to look out for, especially if you're a Canadian dividend investor. All right, so the next stock we have is PIF. This is Polaris Infrastructure. Now, this one we bought a long time ago, and it's kind of been sitting inside our portfolio. Like, we bought this when we first started. It was recommended from somebody from the channel, and for some reason, you can't buy it on Wealthsimple Trade. Like, it doesn't meet some kind of standard or something. I'm not too sure what the actual issue is, so we kind of just been holding it over time kind of thing. But we have 12 shares of Polaris, $158 in value, -10%, so they took a pretty big hit. Pretty high yield, but I'm not too sure how the stock is doing, so that doesn't mean go buy it because I'm not too sure how they're doing actually. But PIF, yeah, it's kind of weird. Like, there haven't been that many people buying it, and it's kind of just been going downhill. So it'd be something to kind of look into, but for some reason you can't buy it on Wealthsimple Trade. So we've kind of just been holding a few shares we bought in the past. At that some point in time, I probably won't be buying PIF. It's not one I'm going to really pay attention to. We're just kind of holding it just because, and maybe over time it might rebound, and maybe we could sell it going into the future. Next up we have is RNW. This is TransAlta Renewables Incorporated. This has been one of my best performing stocks overall. Somebody recommended this stock to me, and it's been doing really, really well. So we have about, over the past day, we have 0.47% gain. But if you go over the past year or so, we can see that it took a big hit on the pandemic, but look at the recovery, like especially specifically in the past like 3 months. Look at that nice recovery. So they're doing really, really well, and our portfolio is looking really, really nice because of it, or at least this part of our portfolio is, I should say. So we have 15 shares, $253 in value. Too bad we didn't buy a little bit more, but return is 17% right now. I wish I would have bought more, but hey, you know what? I'll take the $37 with a nice yield here, and it is a monthly dividend stock. So really nice stock. It looks like they're doing pretty good, at least in terms of share price. So maybe it might be one to look into. The only big question now, is it too late to buy? I don't think so, but hey, you know what? We did really, really well with that one. Next up we have is RBC. We own a lot of shares of RBC. We only have 1 share of the individual stock, but VDY, the ETF we have, the main ETF, actually has the largest weight in RBC. So we actually own a few shares of RBC, even though it shows only 1 share here. But total value about $100. We bought this way back in the day, and we're down about -3%. Current yield about 4.52%. So nothing too big there. Next up we have is Savaria Corp. Savaria Corp, SYS. They did really well at the start of the pandemic, but they're starting to kind of level down again. -1.5% in the past day. 8 shares in total, $115, and they're up only 3%. They were sitting up like in the over 10% for a long time, but it looks like they're kind of leveling down now. Maybe it might be a good time to buy, but it's hard to say because they haven't had a good history in the past. Like, they've kind of had I don't know, it's hard to say, but like, they might be a good stock. You might have to just look into it a little bit more. But going into the future, you know, the focus on healthcare and stuff and accessibility and stuff like that, it probably would be a good stock to buy, or at least to add a little bit of shares into. So we have 8 shares. We probably will be buying more in the future. and that's the Varicorp. They've done okay so far. Next up, we have Shaw Communications. This was the very first stock they had inside this portfolio. We bought one share of Shaw, or a couple of shares of Shaw. I think that was in like the very first video. If you guys want to check that out, it's kind of funny. But we've been buying a few shares of Shaw over time. Once again, this is one that is inside my ETF, so I don't buy too many shares of it because of that. We have 11 shares of Shaw, $269. They're a nice monthly dividend stock, 2.57% total return, so they're not doing too bad with a almost 5% dividend yield. So they're a classic Canadian telecom company, and they're doing pretty well. So maybe Shaw might be a good company to kind of hold, just like a nice little stable to hold inside your portfolio. Okay, so hope you guys are still with me as we dive into the deeper depths of this portfolio. We're almost there. We just got a couple more stocks to go. Next up we have is my favorite Canadian bank. I've done so many videos talking about how TD is so great, but I really think it is one of the best Canadian banks. Currently up 1.15% in the past day. This is the individual stock, Canadian bank stock I'm buying the most. We have 9 shares, up 2.64%, tons of potential in the future, very good finances, very good payout ratios, very amazing dividend growth, and a nice dividend yield right now. I think this is a really good stock to buy. We've been buying it on a regular basis, and it is inside my ETF, so we've kind of stocked up a little bit on individual shares just to get a little bit more as well. But I think TD is definitely going to be one of those big companies that's going to do really well in the next couple years. So next up we have is the main ETF inside this portfolio. This is VDY. I think in my last video I talked a little bit more about VDY, so check that video out. But we're currently up about 1%. So this is like a good indicator of the overall Canadian market. So the overall Canadian market is about 1% in the past day or so, but it's still been kind of like ups and down. Over the past 3 months, it has been going downhill. So it's a really good time to buy Canadian stocks right now because everything is kind of going back down. Like we're getting maybe not like March levels, but everything's kind of creeping down. So good time to start buying, good time to start getting stocks. Who knows what's going to happen? Like they could rebound over the next couple of days, or they could keep going down. We just have to wait and see. But nonetheless, it's a great time to be buying stocks. We have 57 shares, total value of $1,660, negative 3% overall. But once again, I don't care about that because the lower it is, the better it is. I'm going to keep buying. It's a nice monthly dividend stock, and we have about, I think I'm going to make this about 30% of my portfolio is going to be the goal, and then I might make 40% US stocks, and then we might, I guess that'd be 50, 60, 70, and then we might leave the other 30% to kind of just buy and trade some individual stocks, or we might do something like 50% US stocks, 30% Canadian stocks, and then use the extra 20% to buy a little bit. There'll be Canadian stocks that we buy anyway, so it'll kind of end up being balanced in the end regardless. But this is a nice, good ETF right now. I think a very undervalued ETF and one of the better Canadian dividend-based ETFs. So I think this is a really good buy right now. The next up we have is VYM. This is the main US fund. This is the main Vanguard-based US fund. Once again, nice thing about these funds is they have really good low fees. VDY has a little bit of a higher fee, but VYM has almost like a non-existent fee. It pretty much costs nothing in terms of fees. So that's really nice over time. This is a US fund. It holds like it's kind of like the dividend version of VTI. So it's got a lot of good dividend-based US stocks, a lot of dividend-based growth stocks. We bought 2 shares. We're going to be buying, like I said, a lot more over time as time goes on. It's only $162 of the total portfolio value, but total return is negative 2% because when we bought it over the past, I think we started buying about a month ago or a couple weeks ago, the stocks have kind of dipped down a bit. Dividend yield is about 3.55%, so not too shabby. And this does pay a quarterly dividend, so it's not a monthly one, it is a quarterly one. Next up we have is VYMI. This is one I bought a long time ago, an international fund. I'm just holding it. I'm not going to be buying anymore. Down at negative 15% right now, so it took a big hit. But you know, if you wanted to play a really high risk play, you could buy this ETF or these international stocks, hoping that maybe next year they go up like 20% and you just get a huge crazy gain. But that's really high risk. I don't know if I would do that. I think holding some international equities is great and great for diversification because sometimes they will grow. But this, I have that in my main Wealthsimple Invest portfolio, as you guys have just seen. I don't need any more diversification, so I'm just going to hold these until they go up and probably sell them at some date or just hold them forever. I don't really care. Next up we have is XHD. This is the US based fund I bought initially, but I'm moving away from it because it's Canadian hedged and it just hasn't done as well as VYM. So we're still going to hold it. We're still going to get the dividends that it gives. It does give a monthly dividend. We have about $821, but we'll just hold it just over time. Currently down about negative 4% and a yield about 3.72%. So this is one we bought. It's a Canadian hedged fund, but I'm going to move away from it. I'm not going to be buying in the future, and instead we're going to be replacing XHD with VYM. So let me know what you guys think about that in the comments section, but I think that's the smarter move to make. And then going into the bottom here, we have XRE. We bought XRE like when I first started the portfolio, but then I decided I was going to make a separate REIT-based portfolio. So I don't know, just kind of ignore this if you want. Once again, we're just going to keep it just because. But overall, we have 29 shares, $426 total value, and down about negative 13%. So as you guys can see, REITs have taken a big hit. They did recover a bit in the past couple days, but they're still down quite a bit overall. And then at the bottom here, we have a Bank of Montreal Canadian High Dividend Covered Call ETF. ZWC, we bought a few shares of this a little while back. It's doing okay. $183 value, total return about $5, so it's not doing too bad. But this, we haven't been buying some. I might buy, it's kind of one of those stocks I buy if I have a little bit extra money sitting inside my portfolio. So we kind of just been buying a few shares every now and then kind of thing. And then we have $7.97 inside the portfolio. I don't think we can buy anything today, so we're just kind of skip that for today. But let's take a quick peek at the dividends, because we have gotten some dividends over the past couple days. And then once we go over the dividends, we'll jump all over to the REIT stock portfolio and we'll go over the REITs. So if you guys are still with me inside this video, we will cover the REITs in just a second. So we'll go dividends and we'll go to the tax-free savings account and we'll go over the dividends really quickly. And as you guys can see, September has been a good month for dividends and they're starting to rack up. Like when I first started this portfolio, you know, I'll go down to the bottom just really quickly to show you guys. But as you guys can see, when I first started this portfolio, we were getting like 44 cents, 27 cents, 30 cents, 22 cents, 82 cents, 96 cents, you know, but now from our dividend stocks, we're getting more along the lines of $1.32, $2.61, $1.68, $1.10, $1.55, 99 cents, $1.90. So it is starting to add up, $4 from VDY right there. So it is starting to add up over time. And once again, we are taking that money and we are reinvesting it to get those nice compounding rewards. So you guys have any questions about this portfolio, let me know in the comments and I'll answer any questions you guys have. Let's move on to the last portfolio, which is our REIT stocks. Over the REIT portfolio really quickly inside this video, I'll just do a quick little update on the monthly earnings from the REIT portfolio. So in March we made $1.29, and as you guys can see, just like our dividend portfolio, it slowly increased over time, $4, $8, $11, and then $24 in September. So our REITs are starting to get some nice monthly income, but over time I'm going to kind of move away from them. I'm still going to put money inside the REIT portfolio, but I'm focusing on the dividend portfolio for now, and I'll probably put like a little bit less inside the REIT portfolio. As you guys can see, in September we only put $355, so we're still putting a decent chunk of money, but we're just going to put a little bit less and focus more on dividend stocks, because I think investing in some of the bigger banks is like a safer and better play for not only the short term but also for the long term. Like these REITs have gone down a lot recently, and they might eventually rise up, but it's just the long term of some of these REITs, long term like sustainability, nobody really knows what's going to happen. So I'm focusing predominantly on the dividend stocks, but I still will be building out the REIT portfolio as time goes on. So here's the REIT portfolio. At some point in time, I'm going to combine this probably within the next couple months into my TFSA, which holds my dividend portfolio, and I'll just stick the two together, and I'll go over the REITs, separately, but I will kind of keep them inside one tax-free savings account, so it's all tax-free, because right now this is sitting inside a personal account, and I wasn't too sure if I wanted to keep the REITs in a TFSA, but kind of as I learn more and as I put more money into them, it's starting to get to a decent chunk of money, and making $24 a month, I kind of want that to be tax-free. So yeah, a very smart move to make. So I'm definitely going to be putting that inside of a TFSA very, very soon. So we have $4,016, up $23, 0.6% in the past day. In the past week, REITs are up about 4% almost. So REITs went up quite a bit in the past day. We'll have to wait and see what happens going into the future. If they're going to stay there or go up even more, up $146, so not too shabby. In the past month, we're up 1.44%, and then all time the REIT portfolio is up 1%. So our REITs are doing better than our dividend stocks right now, oddly enough. We'll just have to wait and see, how long that lasts for. So here's the REITs inside our portfolio. So there's not as many. We'll go over the ETFs really quickly first. So ZRE is one we bought a little while back. I probably won't be buying any more of this into the future, but we're just holding it to get some of that passive income. 3% total gain overall, 365 total value with 19 shares. So, I'm just kind of holding this and we're getting that monthly dividend, and I've just kind of been buying it here and there, but it's not one I'm mainly focusing on. The two ETFs I'm mostly been focusing on are XRE and VRE, and they were buying some individual REITs here and there. But then one of the main ones is XRE, currently sitting at looks like about 0.14%. So compare this one to our dividend portfolio. We have 48 shares, $706. 17% of the portfolio with a negative 4%. So this one's actually doing quite well, and this is because we've been buying it throughout the dip. So you can see, compare that 15% in the other portfolio we're sitting on, and compare the 4% in this one, just by regularly buying in throughout the dip makes a big difference. That's almost like a 10% difference. So it really does add up over time, guys. So buying through the dips is super, super important. So this is a nice ETF I think is going to do well going into the future, and because it's so cheap, I think it's a great buy. VRE I think is a little bit more of a safer REIT ETF, and as you guys can see, we're currently sitting at about 44 shares, total value $1,184. It's almost 30% of my portfolio, and we're currently almost breaking even. So this is really nice to see, really nice yield that's going to start compounding on a monthly basis. So if these REIT stocks continue to go up, this portfolio should rise up quite a bit, because we did buy a lot during the dip, and REITs got hit pretty hard. So we're going to get a nice gain if things do go up. Next up we have is REIT. This isn't one I've been paying too much attention to. Once again, I bought it way in the past, 14 shares, but it is up 5%. So that's nice to see. So that might be one I might look at into the future. The big ones I've been focusing on are RioCan, of course. It's one of the most famous Canadian REITs. Lots of longevity. This is probably one of the ones that's going to last if things do last. If REITs do last. So that's why I've been buying so much, even though it's been kind of doing not so great in the past year. You can see it's down quite a bit, but I think if anything is going to sustain itself, and if the real estate market is going to recover, it's RioCan probably will most likely do well. So that's why I've been buying it. But we're currently sitting at about 41 shares, 591 total value, currently sitting about negative 5%. So we're still kind of got some gains to go, but we've been buying a lot. So as you guys can see, it's even kind of dipped a little bit. So if once it does go up, we should do a nice return from that. Next up we have is H&R REIT. This is another one we've been buying into on a regular basis. 48 shares, total value $485, total return 2.6%. This is a little bit of a higher riskier REIT, especially since they did cut their dividend, but their price was so low, I couldn't resist not buying throughout the dip. So I think going in the future, it's just a little bit of money in the end. It's not even that much, but if they do recover, I think we'll do well. And even with a cut dividend, because we bought it throughout the dip, we did get a lot of shares with the current dividend, so it's still pretty decent in the end. Next up we have is Dream Industrial. This is the new REIT I kind of added in. We've been buying it here and there. It's nice and cheap. 5 shares, currently at 0.53%. So that one's not doing too bad. And then the last one we have here is probably the one that's done the best for us. But once again, this is a high risk play because Brookfield Property Partners, I think they're going to do well, and they do have sustainability, but once again, it's hard to say, how many of these REITs are going to last, especially since the conditions are so crazy, and with all the big talk about the second wave and whatnot, nobody really knows, right? But we have 23 shares, $400, up 13%, so not too shabby. Once again, it's done well for now, but we'll have to wait and see in the future how it's going to do. Nobody really knows. So that's why I've kind of cut back a little bit on the REITs, but I'm still going to buy them just in case if they do really well, we should see some nice gains. So that's it for the portfolio, guys. So I know this was a long video. I wasn't lying when I told you it was, but let me know what you guys think in the comments. Let me know what you guys think of these portfolios. If you guys have any questions, let me know. And over the next couple of days, I will be doing a YouTube earnings update, and I'll go over all my YouTube earnings, and I might even include some of my other income as well if you guys are interested in that. So let me know in the comments about that as well. So anyways, guys, sorry for the long video, but I know you guys always like these videos, so I just wanted to publish it and get it out there. So let me know what you guys think in the comments, and if you guys enjoyed the video, please give it a big thumbs up. It really helps the channel out. But other than that, guys, that's all I got for you guys. So take care, have yourself a good day, and I'll see you guys later.